went the traditional path. Hey, go to school, get a job, work for a 401k and a gold watch, and hated it. I loved the work, but I didn't love the culture.
Welcome, everyone, to our Hero Capital Show. I'm your host, Tim Mai, and today I have another amazing guest on the line with us, Mr. Steven Pesavento. Steven is a seasoned real estate investor, has been doing this since 2013, went full time since 2016. And just in that short amount of time, he has acquired over 220 assets, over 22 single multifamily assets, and nearly 200 million worth as a solo partner in the deal, and then over $500 million worth with a partner. He specialized in multifamily value add, core plus, and also private credit. And just in the last few years that I get to watch Steven raise capital for these deals. He raised over $80 million. But I don't know if you see it or not, but I see a lot of his ads. So Steven, super excited to have you on the show with us today. Thank you so much for joining us.
Yeah, excited to be with you here, Tim. It's been great seeing your growth as well since 2020. Quite a few big moves for you.
Thanks. Yeah. Thank you. Yeah. So let's start out. You can share with everyone a little bit about you, how you got started in real estate, and especially like what got you into this war of multifamily syndications.
Yeah, it's a good question. Where we're at today, between my partner and I, purchased over $500 million of real estate. And I've purchased personally hundreds of individual properties. But looking back, I was born and raised in the Midwest, went to school up in Minnesota, where I'm from, St. John's, and then went into a career in management consulting, working with Fortune 500 companies, process improvement, technical implementations. And then that's where I realized, hey, I went the traditional path. Hey, go to school, get a job, work for a 401k and a gold watch, and hated it. I loved the work, but I didn't love the culture. And so I left, went into tech, moved out to Boulder, Colorado. They got a big startup tech scene, worked with developers, and then built my own firm, did a lot of testing on that. And then the takeaway from that was, oh, I really want to work on something that's real, something that is a real asset, that's focused on profitability. Because in the tech sector, it's a lot of funny money. Now, you might be able to turn your business into Uber or Airbnb and have 100x or 1,000x return, but most of those companies fail. And it's all about the next funding round. And so in 2013, to bootstrap that company, I started doing Airbnb early days, had 3 different properties, was making a pretty significant monthly income off of those, doing some arbitrage. And then in 2016, went all in on real estate, fired all my clients, had no other way to make money, and just went out and found a way to be able to exchange value, found mentors who had a lot more experience than I, and my technical background was able to come in and just trade my skills for their knowledge and experience. And that led to me partnering with a gentleman who had been a developer and flipped houses for 30 years and built a platform with him, my concept and sweat equity and his knowledge and experience. Bought over 200 single family homes, flipped those within about 2.5 years. And then that transitioned into multifamily. And the real driver of that was when you buy 200 single family homes, you're taking on a pretty significant risk on personal guarantees, on private credit from individual investors. And I'm doing that across the country. And we just got burnt out. Like, it was a lot of work to deal with those individual properties. And the profit per property just doesn't compare to commercial real estate. So I went a path like a lot of other people do, transitioned, did a couple partnerships with people who had a lot more experience, brought some capital to those deals, and then transitioned back into deals that we fully control, execute, and operate. My partner and I, he's got a lot of experience, went full in together about 3 years ago, right after rates started going up. And we've been able to build a great platform, been able to do quite a few deals, even in this challenging market. And I think the reason for that is because of what we're looking for and what we're buying and why that's unique. But I'm sure we'll talk about that as well.
Yeah, actually, let's jump right into that because you guys are buying a unique set of deals where your deals, your business plan is much shorter than most people, right? It's typically 3 years or so. And then, like while a lot of people, operators that, overbought back in 21, 22. You have really been like going deeper into your niche of the marketplace and just been killing it. So yeah, share with us a bit about the type of deals that you do and what make them different from others.
Yeah, so really the genesis of this goes back to both my partner and I's roots in coming from eager means and hustling and building a company entrepreneurially and learning the investment game by doing rather than going and getting a Ivy League education. And so at the core, we're value buyers like Benjamin Graham or Warren or Charlie. We're looking to buy stuff that's well below current value in its condition today. It's being underoperated. There's opportunities to turn those things around. And we're looking at buying opportunities that other people are maybe overlooking. And back in late 2022, as rates started going up, we retooled the platform and said, hey, investing is a game, right? There's winners and losers, and you always want to be on the winning side majority of the time. There's always a chance you're going to lose, but you're not just going to pack up your bag and go home. So we said, okay, what's the rules on the game board today? New interest rate environment. There's a lot of distress. What works? And we collapsed in and focused on what markets do we have the best advantage. And that happened to be Des Moines, Iowa, where we've got an office, and Denver, Colorado, where we have an office. And
Mm,
so anywhere within about 150 miles, give or take, or about a 3-hour drive was our target positioning. So that includes Des Moines, Omaha, Kansas City, other markets within those states, and then of course Denver and Colorado Springs. And so we really break up our platform into really three buckets. We've got a private credit offering, fixed rate of return. We take on the debt risk. I'll talk about what's a little different about what we do than many other people. And we're really truly taking on a lot of that risk. But that goes back to where I started from, raising $26 million of private credit and taking all the PG risk on that. And then the other side of the platform, probably about 60 to 80% of what we do is growth focused. So we're looking at short-term deals, high appreciation, and the ability to go in with high confidence to be able to exit in 36 months. And then the final piece of the equation is more of a pure cash flow equity type investment. So that's both value add and core plus. The value add strategy is trying to find 4 to 6% year one cash flow with a 15 IRR or 2x multiple in 5, or core plus that's a little bit lower on the cash flow starting in today's environment, but has more strong cash flow, and the value add is there, but it's much lower and it's not heavy construction. So what that actually looks like in reality is that because one of our key advantages is in-house construction and property management and a decade of relationships with local Latin labor. My partner was born and raised in Des Moines, but his family's from Colombia. We treat these people like family, and we look for folks that aren't running sophisticated businesses, but are tradesmen who want to stay consistent. And as a result, we can get our construction done at 30 to 50% of what it typically costs, because we run that division at a break even or a loss. And then on the property management side, we're doing something very similar. And so what that typically looks like, what's different about what we're doing than many other people, is we're happy and to buy middle market multifamily. Middle market can mean a lot of things, but what we're really looking for, we were over the last 2 to 3 years, was how can we buy deals that are too big for mom and pops, but way too small for institutions to even open the book on. So that ends up being typically a deal that's below 25 million, kind of optimally in that $5 to $15 million purchase price range. And that the value add strategy comes down to doing a lot of construction. So those are pretty significant renovations to units. It's upgrading the exteriors, it's repainting the hallways and changing the look, feel, and most importantly, the smell of those buildings. And as a result, we're typically raising rents by 30 to 40%. Because again, we're buying buildings from people who've owned them for a decade, and they've used that building like a cash machine. But instead of putting money back into upgrading the property to get market rents, they've run it at high occupancy, but without any of the new bells and whistles that are there. And as a result, on 25 exits, we've got an average of a 56 IRR across the portfolio at a project level. And that nets out to about a 30, 35% net LP IRR. Now, The reason we talk about
Wow.
project is because we've got 4 different share classes, from people who are out there raising millions of dollars and investing them in our deal, to family offices who are writing one check, all the way down to people who are investing 100,000 or 250. So each of those tiers has a different profit percentage, in particular because of the administrative cost it takes to facilitate smaller checks versus larger. Just in summary, a big chunk of what we're looking to do is, how can we turn money quickly, and how can we show a result quickly to LPs and deliver them a return that's above market, because that's our core marketing engine. Yeah, we're running paid traffic. Yeah, we're working with fund managers. Yeah, we're out at events and doing those kind of things. But really, like, the main marketing tool we have is results, because we know that when people invest with us and we project a 15 IRR and deliver a 17, they're happy, versus if we project a 17 and we deliver a 16.95, they're unhappy. So that's a core part of the philosophy is, hey, the track record is the most important thing. That doesn't mean there's not challenges in the portfolio, right? Anybody who bought in 2022 or late 21 are going to have challenges, but we've been able to communicate around those and be able to work with our investors to create alignment moving forward, because we know net, as long as you keep investing with us, everything's going to work out in the long term.
Gotcha. Really cool. And you mentioned your sweet spot being 5 to 15 million. How many units is that? And is it Class C type assets that you usually buy?
Yeah, and I'll just say it's worth being transparent. We own an asset that was a $69 million full purchase price plus CapEx building. We own a couple $35, $40 million buildings. We're under contract right now on a $28 million project that's going to print between a 5 and a 9% cash flow, 5% starting, 9% year 3. So it does vary, but on that growth strategy, one of the biggest upside opportunities is doing things that are not scalable. There are a lot of brain damage, but we're good at it, so we do it. But yeah, $5 to $15 million building in Des Moines is going to be between 100 to 250 units. For example, we closed on a deal last year called Oakview that we bought for $36,000 a unit. It was the lowest purchase price per unit in Des Moines in the last decade. And that building, once renovated, will be worth about 2.5x. And part of that is because it was a LIHTC project and we're taking it out of LIHTC. And in November, we'll be fully out of that program. But just as an example, we bought it for 13.25 million, and it was appraised as a part of LIHTC by a certified appraiser at 16.1. That's the kind of value we're looking to buy up front. Now, that deal is bigger. That's sub 15 million. On the flip side, in Colorado, the price per unit is much higher. If we're buying for 40 to 60,000 a unit in Des Moines, and we're going to sell at 80 to 100 a unit, depending on size, type, condition, et cetera. Some can be a little higher. In Denver, we're buying at 60 to 80,000 a unit, maybe even as high as 100, but we're selling at 150 to 200 a unit. So those prices per unit end up being a $5 million purchase, might be 30 to 50 units. So it does vary. And that's one of the things is, like, scattered site projects only work if you own a lot of scattered site projects, because you can't have on-site management. It doesn't make sense. And so we don't want to own those properties long-term, but they're perfect purchases for 1031 buyers who want something that's fully stabilized, or for those smaller syndicators that can really only raise $1 million, $1.5 million. They're the types of people who are coming in and there's still maybe a little bit of value add left for them to pitch to their LPs.
I see. Interesting. Okay. So share with us, like, what is it about your deals? You mentioned about high value add, but what else about it that allows you to exit within 3 years versus others requiring of 5+ years?
Yeah, so it's a combination of things. So the first is basis. We're buying at a low basis, and we're very confident about the basis we're buying at. For example, there's a deal we just closed on about 2 months ago in Denver. We were under contract for 3.5 years, and we were negotiating with the seller for 4.5 years. And we ended up closing that
Mm,
deal with 2% seller financing, 90% LTV loan for up to 13 years, or once we get it approved for the increase with HUD. And so that's just an example of that deal is unique because we're in the market negotiating for a very long time and we're finding something that has a problem, and that relationship with the seller or the broker is key. So most of these deals are taking 6 to 12 months to go from first knowing about it to being
mm,
under contract. And oftentimes they've fallen out with two other buyers. But because we have a fund and we have capital on hand and we have a reputation in the market of closing, by the time they accept our offer, not only is it lower, but we're giving them a high confidence of close. We're getting in to do full due diligence within 7 days of going under contract, and we're hard pretty quickly after that. So that's what leads to low basis. These are not fully marketed deals, or they were 12 or 24, 36 months ago, but we hang around the hoop and try to make something happen. The second piece is that we legitimately, and I'm sure other people who are in the construction game can respect this because I'm sure they have a similar advantage, because we do construction in-house and we're managing it and the subs, we're reaching deep into the sub pool, testing people. 1 out of 10 subs stick around because they're good enough and the price is right. But we just use those people over and over again, keep them super busy. So our cost of execution is lower. And then the third piece is that the platform was built initially around flipping houses and then flipping apartments. Those kind of things typically happen in 6 to 12 months. On these smaller, mid-sized buildings, we'll clear the entire building. So we're going to provide notice to everybody in a 35 or 40 unit building if there's problem tenants or dangerous type folks that are living there. And so then we're able to get our crews in and renovate everything very efficiently, and we'll be ready to go back to market in 12 to 18 months. Now, on larger assets where cash flow is important, or we want to limit the burn on the property, maybe we're doing that in segments, but the only way you can turn units at this kind of pace and speed is by being able to have your construction team go in, turn those units quick. And then the second part of it, or part two of that, is on the property management side, because it's in-house, or even if we're using a third party, we've got an incentive built in with our team around leasing, because when you got a building going from vacant to leased up, you've got to do it fast. So it's not dissimilar to leasing a building development related, even though the risk on this is way lower than development. And from our perspective, the basis and the equity that we're growing kind of de-risks these deals quite a bit. That's the other big piece, is we're able to get people in quickly that are great, fully qualified tenants that if we have to hold the building, we're going to. But kind of everything we do is built around, hey, how can we exit this as quick as we can? And we're incentivized around doing that. And so that's the core of it. Now, to be clear, not every building is a perfect fit for a 36-month term. Now, it comes down to debt, LTV, comes down to prepayment penalties and those kind of things. And the projects that don't fit the ability to turn out of it in 36 months is going to be more of one of those cash flow plus growth type opportunities, which don't go into our fund. And that's the core of it, how we go through that.
I see. Very interesting. Okay. So walk us through like your growth process. You started out with the smaller multifamily, like major value add. And then when did the Core Plus came in, or the private credit came in?
Yeah, so private credit was essentially what we started with when we were flipping houses, because we're
Okay.
borrowing money from individuals at 8 to 12%, and we're giving them a return on that 8 to 12% regardless of the success of the project, and we make all the upside. So we're taking all the risk, but we're going to get the upside on that. And then that transitioned into equity as we went into multifamily. And then we
Okay.
transitioned back to adding that to the platform because we realized so many people wanted that consistent return, lower volatility. But the growth for us was really, okay, we have the markets that we're in, and we have the experience and we have the expertise, and most importantly, the team in place to be able to do that. And we went and did some deals with some other folks, and we didn't really like the way that stuff went, right? Reporting wasn't transparent, communication wasn't transparent, things are late. You're fighting with people to get the information. It's just not a great experience. And so that was a great eye-opening experience for us where it's, okay, this is not the way that people should do business, right? People should be going out of their way to make sure that the end client is happy, right? End client being the investor, or end client being the fund manager allocator who's working with that investor, all the way down to the tenant. And so that led to us quickly pivoting back to control, being the person who's driving the ship, because we've got the experience, expertise to do. And we, in a perfect world, Tim, we probably wouldn't buy a 30 or 50 unit building. But it's hard not to when you're talking about 100%, 200% IRRs. And to be clear, a lot of those exits of those 25 were before rates started going up in 22. But 2 out of those exits were in 23, 9 to 12 month holds, meaning we bought them in the market that we're in today and we sold them in the market we're in today. And so it's like when you buy and you put on debt in place that's got a 3 to 5 year term with no prepayment penalty, typically 5, you've got optionality. Worst case scenario, or IRR goes down because you're holding on to it, but you don't have to sell. Like, you're not under the gun, you're not being squeezed for it. But if you're able to turn it around and bring that opportunity back to market, then you're able to shift those resources, that capital and those results into a new project, which is actually, it's not the perfect time to sell stuff bought in 21, 22, but we are looking at selling some of the projects, even if we think in 2 years it'll be a little bit better, because in discussions with our LPs, they're like, hey, look, this is one of the best times to be buying, especially if you're patient and you're out there and you're able to move quick. They want to loosen up. Oh, cool. I thought I was going to get a 15. I'm going to get a 12 or a 10. I want to move that money into something that's going to make me a 20. And like I said at the beginning, I don't know if I mentioned this or it was on another conversation I was having today, but like, our focus is on relationship over everything. We turn down LPs on a regular basis that are jerks, that don't have the right mindset, that maybe they shouldn't really be in private equity or private credit or private real estate. But at the core of it, like, we want to have a multi-decade relationship with our investors and our capital partners. And we don't just let anybody invest with us. So if there was anybody on this call who was like, hey, I like what they're talking about, I'd love to get in on a deal, it's probably 3 to 5 conversations and talking to some other folks that you've worked with before we're going to let somebody come in and do that, because we want to make sure that you're going to carry that same quality to your LPs, because we're going to be connected to you. And we want to have good partners that it's easy to work with, right? Because capital is a super important piece of the equation, but the relationship is probably more important. I think that's what's kind of led to the growth that we've seen. And we're fortunate to still have great deal flow, but it's a challenging market out there. There is less opportunity than a lot of people think there should be, given where things are at. But we're still finding deals from banks, and the deals are only getting better the longer the bank owns it, because banks don't know how to operate properties well.
Correct. Yep. I totally agree with you. So let's talk about your capital raising side a bit. So you guys, yeah, raised over $80 million in the last few years. And I see a lot of your ads, and I see them both for your private credit as well as your equity side. I guess before we go into the ad side, share with us some of your, like, your best channel that you have found to attract investors and raise capital.
Yeah, and I think it depends on when in our growth cycle that best channel is. I would say early on, I don't come from money. I don't have friends and family with a ton of money now at this point. Yeah, some friends with money for sure, but I was always hesitant to raise for my personal network. I never liked asking people to participate. Now, I've maybe gotten over that a little bit, but it's not my kind of primary focus. And some people are really good at that. And starting out, the podcast was one of the top 500 podcasts in the world and over 1 million downloads. And at the time in 2019 to 2021, had a pretty significant listenership. When there was the passion and the focus, that was huge. And so when people listen to hundreds of hours of you talking, and then all of a sudden they have an opportunity to partner with you, they line up and they move quickly. And it was a different time in the market. We probably raised 15 to 20 million from the podcast. We do that show now in seasons. So it's not a twice a week show like it was for many years, but that was a big tool, right? Thought leadership. get on stages, get in front of people, show them value, show them who you are, and they're going to come up to you and ask to participate, right? Make an offer of value, and then people are going to want to come and exchange and provide value back. The second one is advertising. So advertising can come down to newsletters, it can come down to paid traffic on Facebook or Meta or LinkedIn or any of these places. I would say the way we think about paid traffic today is making sure people know who we are, what we're doing. And we do get a number of great qualified people that come in through that channel. It's very expensive. It's not a great channel for people who are new. It's a better channel for people who've got a full team. So the way my organization is set up is leads that are coming in from any channel, whether it's being on a stage at an event, speaking on a digital stage, being on a podcast from our podcast, from any channel, online, search, etc. That's all coming into our database. We use HubSpot, enterprise version, for everything. So we track everything. And then we've got a team in place that's going to call and build relationships with those people. And we really want to get to know everything we can about them. And we really want to be a trusted advisor. And so we focus on building that relationship. We work on bringing them into real life opportunities to meet in person and build trust. And then we make offers to participate in the things that we do. And the number one channel for us at this point is referral. Most of the referrals are the fastest people to be able to close. They're the fastest people to participate. When people have a great experience, they're going to come in droves. But advertising is a powerful way to continue to talk to those people who maybe aren't getting your email or being reminded that you exist or getting that first introduction to you. Because in the world of digital marketing, you have the opportunity to follow people around the internet and then them hear more about you. So that's the core channels. And then I'd say we work with a handful of allocators, fund managers, co-GPs that raise capital. We've raised 90% of that money or more. So we've got a couple folks that we've got a deep relationship and can raise a lot of money and are really easy to work with and are professionals. We've got a new gentleman joining our team shortly who's been deep in that space. So he's going to work on building out a program and really helping people to participate with us, because we know what it's like to be on the wrong side of the equation. So we want to build something that people feel like they're true partners and they get to deliver a great result back to their LPs.
That's good. That's excellent. You mentioned a lot of your people now comes from referrals. I would assume they come from referrals of existing investors. Is that correct?
I'd say it's a combination, right? It's a combination of you're meeting with somebody in person. It's not an investment meeting. And I show up with the intent to add value and I ask them questions and get to know where the things are. And I make introductions to people that are valuable to them. And everybody always asks, when you ask, hey, how can I be of value or service? They always ask back. And that request to me is always, hey, who do you know that fits this category, that is a driver, that's looking to create a better life, that's an entrepreneur, that's doing this. And it's a personal relationship building thing for me to fill my own cup. And then as a result, those people, some of them end up being investors because they're interested in what you've got. The other key thing is when getting on the phone and talking to people, it's just reminding them, hey, I really build my business based on referral, and I'm really glad to have you involved or interested. Who else do you know in your network, your friends, family, people who you think meet the cultural values of the firm that we should have a conversation with, like a no pressure conversation? And that ends up leading to pretty significant results.
That's amazing. Wow, I love that. On your ad side, do you happen to know some of the numbers? What is it costing you per $1 million raised or some kind of metrics like that?
It ranges based on the type of campaign. From a blended number, it's probably somewhere in the like 3 to 5 to 7%. If you're doing geo-targeted stuff, it's probably on the higher end, 7 plus. If you're targeting people who only can write $1 million checks, it's a little bit higher than that. The way we think about it is marketing via advertising is not the main way we're going to go about getting clients, but it is a good thing to supplement, to stay out there and stay relevant. And when you think about that from an investment standpoint, let's just hypothetically say it was 5%. So that means it costs $5,000 per $100,000 that comes in. That goes down over time. If somebody reinvests, if someone refers, your lifetime value of that client is going to be a lot more palatable. Up front, you're making a significant investment. You're maybe running the firm at a loss if that was your only channel for bringing people in, because there's no way you're pulling 5% of fees off the deal, and you're definitely not able to expense all of that. And at the end of the day, you got to be thinking, okay, I'm making an investment into the future of the firm, right? If I'm spending X dollars, I'm not going to get that X dollars back until we exit the deal. But in the meantime, I'm able to do more deals, bring more opportunities in, bring in more referrals. And if I can serve those people really well, it's going to pay off. But if I don't serve them, then I'm underwater, then I'm in a bad spot. And so that's the way you can think about it. And that's why when you can get in front of the right audiences on podcasts or on stages, sometimes even if you're paying to be a sponsor or speak on that stage, it can actually be quite cost effective. If you've got a good message that is going to resonate with that audience, your cost per lead is going to be a lot lower than if you're running paid traffic. And I'll tell you, paid traffic in 2020, way cheaper. It's gone up. Ever since COVID, anything digital has gotten more challenging. That was, in the early days, that was one of our advantages. And then everybody was forced to use digital media, and it's become maybe not the best tool. It's still valuable to keep using, but you can't build a business just based on that.
Yeah, so no, that's really good. I didn't know that. I expect that it goes to 5%, but I didn't know that it can go to even 7%. That's, yeah, cost of money is definitely pretty high on running ads.
But if you think about it from a comparison standpoint, just to put it in the reality for everyone who's an allocator, okay, if I go and work with a broker dealer who's going to go and bring capital to my deal, they're going to charge 1 to 3% upfront on the capital, plus they're going to pay somebody 6 to 9%. So your total cost of capital could be anywhere as low as 7, as high as 12. And that's an upfront fee either to the LP or to the deal. And they're not going to get upside on the deal, but that's why it can be advantageous for fund managers, because you actually have a value proposition where you say, hey, I'm going to get 1 to 3% upfront as a fee that I'm charging my LPs, but I'm going to make more than what the broker dealer is going to make, but it's going to come out of the success. And so that's where it can be advantageous, right? Because it's okay, if I have somebody who's out there working their leads, their network, they're running their own business that's then entrepreneurially plugged into my business, and it's a win-win arrangement. Okay, I don't have to spend as much money up front, but it's costing me not that different in the short run, but it's costing me more in the long run. But now we're aligned, and that person's essentially running their own business plugged into ours. And so that's where there can be a really positive kind of ecosystem play, where if you can find the right folks to work with you and they get value and you get value, like that's why I think the broker dealer world's going to die. I think it still exists because old people are used to paying big fees, but the younger generation isn't. And there's a lot of talk about that part of the world dying. Now it's not, because there's still a lot of people who are pretty comfortable in that space, and you can raise a ton of money through broker dealers if you've got the right thing, but it's expensive.
Yeah. And even the broker dealers themselves, a lot of people are getting out of that space too as broker dealers because of all the regulation changes. Makes it harder for them to raise more disclosure, less things that they can say. They can't even mention IRR, any of that kind of return. So yeah, there's that side to it. Have you considered running ads to an educational webinar instead of directly into the fund?
Yeah, so we've tried those types of things before, like education funnels. And transparently, like the podcast used to have a coaching component. I would make some pretty good money and got to help a lot of people move forward in whatever they're doing in their life and business. And that was fun, but it wasn't, if you look at the possibility in real estate, it's cool. I'd rather just do this for free and help a few people out versus the other side of the education component. But what I would say is,
I don't mean that kind of.
No, I know, but what I would say is that it works for sure to bring in lead flow, but you've got different buyer intent when they're searching for information versus searching for an opportunity. So I would
Mm,
say we leaned less into the education, although I think there's a great opportunity to lean more into it and been more focused on people who are looking specifically for what we're looking for. Because if you're retargeting folks who are landing on your stuff anyways from a variety of other places, they've got some buyer intent. And then if they get on the phone with you, then they obviously show more buyer intent and you can hear whether they have it or not. And then if you're staying in contact with that person, like this is the biggest tip I can give to anybody who's looking to raise capital. The number one thing is that I used to run webinars and raise $5 to $7 million on one webinar, and I would oversubscribe it pretty quick. What's different today is that it's a relationship game. And so I think the biggest advantage you can have is that you can walk people through a process to get to know them and have them get to know you, where you can understand everything about them, ask them questions through, you call it a sales process, but it's not about selling, it's about qualifying. And so it's like you're asking the way you set up the beginning of the call, like the purpose of the call is to really get to know you and see if it's a good fit. And if it's not a good fit, which I'm going to let you know if I don't think it's a good fit for you, or are you opposed to doing the same for me? And everyone always says yes. And
mm.
then it's okay,
I
well,
love
it's a
that.
30-minute call and I'm going to wrap up because I got another call just like this after. And I really do. And then you get in, hey, what do you do for a living? How long you been doing that? Tell me about your family. Kind of what have you done investing in the past? What's your investable assets or what's your net worth? I have to ask for compliance reasons. How is that divided up? Where are you invested? And all these things are all leading into, okay, any pushback anywhere along the way, the answer always is, hey, look, if this is not a fit, I'm going to let you know. But the thing I want to make sure to avoid is that if you do decide to work with us, I don't want you to invest more than you should into a deal. As much as I would love to get 30 or 50% of your investable assets into a deal with us, I actually don't want that. That's not good for you and it's not good for us. And so when you go through that process of building that relationship and then you finish it, talking about the culture, the values, how you do what you do, why it's different. And at no point in time are you pitching deals, right? Like your discovery. And if people are really interested, then you book another conversation to talk about opportunities. And you have 6 to 7 touches before they actually go all in and make that commitment. And what you avoid in the process is you avoid getting people in who shouldn't be in, and you get people who come in with the right set of expectations, risk factors, understandings. And that's going to make a much better experience long term, because once somebody goes into a private investment, they're in for 3 to 5 years or longer. And they need to understand that. They understand the pros and cons and why it's a good fit for them. And on the back end, then you're going to get more referrals because they have a personal relationship with you and they're less likely to blow off your call or email. And you're really training them to communicate with you in the way that you want so that you can do what they want you to do for them. Because at the end of the day, if you're raising capital or running a real estate operating platform, like you work for the investor. It's your job to go out and find deals, but it's their job to write checks and to tell you why they're not going to. And so you do need to set those expectations. Otherwise, you get this weird dynamic where the power dynamic shifts and you're chasing them. And that's not a good place for you. And it actually doesn't make them feel good. It makes you feel less valuable and they have less trust versus when you get people who are aligned with those expectations up front because you walked them through a process, they're going to be much happier with the decision to invest with you.
Very cool. 7 touches is a lot. Is that still the same, even them coming from your ads?
Yeah, I'd say it's 7 touches unless it's a referral. You might do a two
Wow.
call close on a referral because they essentially had infinite touches from whoever it is that referred them and that trust is transferred. But you got to think about this, like they're writing a check for 100,000 or 1 million or $10 million. They need to
Hmm.
know that you're good. They need to know that they feel good about it, that because people make decisions emotionally, but they justify it logically. So whenever anybody ever says, hey, your returns aren't good enough, that's a logical reason. There's an emotional reason behind that that's telling them that matters more than something else. And
Hmm.
so when you have that relationship, you meet in person, you talk on the phone, you have a Zoom call, you invite them to a webinar, like you go through a nurturing campaign via email, they hear you on a podcast. All of those are touch points where they're being indoctrinated into the way that you think, or another way of saying it, they're getting to know you, right? They're getting to know how you think, why you do what you do, how you're going to treat them when things don't go well, or how you're going to treat them when things go well, and what you expect to them. It's just like any relationship. If you go on a date with a girl and you're like, hey, let's get married, let's have kids, this is exciting, and you're on the first date, the girl's going to be like, dude, get the out of here. What are you talking about? I don't want you. But if you're like, hey, look, I've got a lot of opportunity and I really want to get to know you personally and see if this is a good fit and see if it makes sense for us to date and see if it makes sense for us to at some point get married. Do we want the same thing? And I don't need you, but I'd like to have a relationship with you, right? Like it's a shift of dynamic. And the part of the dating process is those touches, is for them to get to know you on a deeper personal level and vice versa, and feel like you do have their best interests at heart. And as a result of that, they're more likely to take that big step forward of getting married on a deal for 3 to 5 years. And you do that through communication.
Gotcha. Okay. Yeah, no, I was a bit surprised because I figure, like you said, the people that are coming from the ads, when the advertising specific to the deal or the fund, that they're coming in with higher buy intent, that you can do a two-call close, but apparently not. So cool.
Anything's possible, but I'd say it's pretty rare. And I'd say it takes about 180 to 240 days to close someone from cold traffic. Yes, there's some people who close faster, 30, 60, 90, but it's rare. It's really a long-term nurturing campaign. And it's shocking, really. If you really think about it, it's shocking that somebody would invest after listening to a podcast or after finding you on the internet. But people are much more comfortable with that today than they ever were. But they still want to have a relationship. Because if you think about it, what's the advantage if you're talking to an RIA or a client? What's the advantage of allocating to Blackstone or KKR or Apollo or Bridge? The advantage is, oh, these guys are really freaking big. Like they're big dogs. And therefore, they've got huge built-in long-term trust and track record, brand recognition. So I'm a little bit more comfortable, but I'm going to get a 12% return or 14 maybe. And that's good. It's like best of best. Versus when they invest with the boutique, and any of us on this call is a boutique, there's no major players in here that are at the level that I was just referencing. They've got to essentially, you've got to transfer that trust to them, and that trust, the advantage of a boutique firm is, dude, we're going to work way freaking harder than Blackstone. The deal's not going well, Blackstone's going to walk away. It's not worth their time. They're moving billions of dollars, tens of billions of dollars, hundreds of billions of dollars. We care. Like, we're going to keep busting our butt, and you need to know that, and you got to trust us, and you got to know that our families eat based on the success of these deals. So we're pot committed. We're 100% invested in our own success, and people buy that. And as a result, instead of getting a 12 or a 14, they're getting a 15 or a 17 or a 20 or a 30. And that's more attractive. And so I'll shift over to something that you and I had talked about. Like, we've moved a little bit more into some more institutional capital conversations. I call it quasi-institutional, more emerging fund manager type programs where, these guys are going to allocate to somebody with $500 million. Like those guys, the big guys, they treat you, all they care about is the numbers in the deal. Almost nobody else should be sold based on numbers of the deal, because I can change a couple of things in the underwriting and I can make any number, anything. But when it comes to RIAs, like, that is one of the unique selling points is I'm like, hey, you should put your client to Blackstone, because no one ever got fired by bringing IBM into their enterprise or investing in Blackstone. But you should invest some portion of your client's capital in the deals we're doing, because if I can deliver a 17 and you're getting a 12 from Blackstone, your blend is going to be 15. You're creating alpha that your client wouldn't have, and you're not taking that much additional reputational risk doing it. And so even with those big folks, like, it still is a relationship game. We closed a small family office on that HUD deal that I just mentioned a couple months back. And the guy flew out to Denver. He liked the deal. He looked at the deal because of the numbers, but he left the meeting saying, I like you. You remind me of me 40 years ago when I had nothing, and I want to back you. And his son was like, dude, literally, this guy never invests with anybody else. I don't know what happened. And so at the core of it, even for somebody at that level, it's still the relationship, right? So the expectations are higher, the due diligence is higher, the checks and balances are higher, the control might be higher, but like they still got to like you and believe in you and trust you.
That's good. So good. All right, Stephen. Yeah, I know you work with fund managers as well. There's quite a bit of funds managers here on this line. And just in general, whether they're looking to invest with you as an LP or invest with you as a fund manager, where would you like to send them?
Yeah, the biggest thing is if you're interested in investing with us, an LP or fund manager, shoot me an email personally, Steven@vonfinch.com, Steven. And either I'll personally get in touch with you or somebody from my team will get in touch and we'll have that kind of opening conversation. When it comes to the fund managers and folks that are allocating or raising money, like just come into it knowing that, yeah, there might be an opportunity to do something together in the near term, but we really want to get to know you. We want to understand what your motivations are, what your experience is, how you work with your LPs, and then of course, plug you into the right kind of deal that's going to fit what is meaningful to you. And just know that we know what market compensation is, and we're going to pay higher than market because just as we do with our LPs, we want to under promise and over deliver. And we know that you got to make some money up front to keep the machine working. But if you're somebody who's focused on creating wealth through serving your investors well, like it's a perfect partnership. So yeah, you can learn a lot about us at vonfinch.com. There's a lot more information that's not on the website. You got to talk to us to get to know. But yeah, reach out. Just shoot me in a message. Tell me that you came from this conversation and tell me what your goal is. Do you want to invest personally? Do you want to invest for other people? Yeah, I'm happy to share what's valuable.
Excellent.